Hi everybody, welcome to the Thursday evening financial thing live stream from a balmy Orlando, Florida. Temperature 23 degrees today. Very warm, but I think we're going to get down to 8 degrees, so that's cold. But not cold like it is in the UK, of course. But anyway, I digress. Thank you for joining this evening. Thank you very much. Hope you're having a great week. We're supposed to have Cufflink CEO Narinder today, this evening. Unfortunately, he had to postpone for personal reasons. Going to be rescheduling him for December, hoping in the next 1 or 2 Thursdays he will be here. So apologies for that. I have no control over these things. It happens. People have personal lives, and it is the evening time. So unfortunately, let me move the chair down a little bit. Oh, yeah. Unfortunately, it happens, so I do apologize. But, yeah, we'll get him back on soon enough in the next couple of weeks. So what else? So what are we talking about tonight? It's kind of, again, quiet on the peer-to-peer lending front, but I did get an interesting email this week from sort of a newcomer into the peer-to-peer investing and generally just investing world, younger fella in his mid-20s who had asked a question about, peer-to-peer lending historical results over the companies that we like to invest through or think are doing a good job versus the trackers. So I decided to kind of have a look back at my own investments over the last 3 years just to kind of see where things were and what the results have been like compared to a tracker, compared to my global tracker, the US tracker, and also compared to the Trading 212 portfolio. So I'm going to show you what those results have been like and kind of talk about risk, because quantitative risk is just so difficult nowadays, trying to figure out where is the risk versus the reward, especially because of the inflation rate, even though it is coming down. So we're told, if those results are accurate, the inflation rate is starting to decrease, but the interest rates are not. And it's kind of questionable as to whether those interest rates will actually start to come down, and even if they do, how much. So you do have this difficult balance of risk versus reward going on in all different facets of investing nowadays, even in property. So yeah, going to talk about that. I have a little bit of peer-to-peer lending news, and I'll show you what's going on in the Trading 212 portfolio. Please, if you can, hit that thumbs up. Let me know that you're alive and kicking. Let me know where you are tuning in from this evening or wherever you are in the world, maybe during the day. Quick hello to everybody. Oh, one other thing. Housekeeping we have to get to. Of course, our sponsor of the show is supposed to be here this evening, but is not. But he will be here soon in the next couple of weeks. Cufflink. If you haven't checked out Cufflink yet, they are a sponsor and supporter of the Financial Thing channel, and also of the Harley Cam. She is bundled up trying to stay cool. I don't know. She's been cold recently, but yeah, welcome. Thank you to Cufflink. Earn up to 9.83% gross per annum. Way over 250 million of UK property-backed investments made since 2016. 0 investor losses to date. Your capital is at risk. Don't invest unless you're prepared to lose money. This interest rate can change, as interest rates do change, and we'll look at that today. You can sign up at the link below in the description or join.cufflink.com/financial-thing. Thank you again for checking out the sponsor of the show. Cufflink's always been very kind to Financial Thing and to myself, so thank you to them for their support. Quick hi to everybody. Colin Perry in the very chilly Peak District. This seems to be a bit of a constant now as the weather starts to cool off for the winter time. Dave Dawson is here in a cold Staffordshire. Peter Vincent, frosty Leatherhead. Alan is here in a cold Worcestershire. Chap in snowy Accrington, maybe. Stephen Hale in a very cold Nottingham. John Day in a very cold Nottingham. And lionfish hunting, of course, making us all very jealous. In 86 degrees Fahrenheit, Grand Cayman, cold at tonight at 77. I think that might be a little bit of a sarcastic note there. No snow in the Grand Caymans. So if you're watching in the future, welcome. Please subscribe to the channel. Check out the Patreon if you haven't. Thank you very much to everybody who has supported the Patreon channel for the last few years. My thoughts are kind of jumping all over the place. Look, I am not the smoothest of presenters. I have zero experience presenting live, and I find my thoughts like ping-ponging all over the place, but that's what makes it live, isn't it? I mean, I'm not one of these BBC presenters, but this is just who I am and the way that I do it, so I hope you enjoy the content at the very, very, very least. Let's get right into it. Share the screen. Brick owner launches a residential property fund. I was really surprised to read this. If you remember, if you've been following the show on the financial YouTube channel for a good amount of time, you'll remember back in 6 years ago this was. And this was a podcast that I did with Fred Bristol, who is the CEO of Brick Owner. Probably should get Fred back on. That's kind of ridiculous. It's been 6 years. But, yeah, you can check that out on the channel, too, if you have not seen it. But we had a really good, really good chat live. There is Fred himself, looking a little hazy with the quality of the webcam back then. But he is apparently with Brick Owner launching a residential property fund, which will be an ISA and self-invested personal pension SIP eligible once it completes the listing process. So this is going to be actually a real estate investment trust REIT, which will list on the International Stock Exchange. That's a big step forward for Brick Owner. You can see here, there is Fred, the CEO. They founded it in 2015, so coming on now 8 years with looks like a decent team that they have assembled there. I don't think they have the biggest P2P lending portfolio, but it's definitely a solid one. I don't know exactly what their numbers are to date, but yeah, I was kind of surprised to see they're going to be launching this kind of a fund. Moving on, Blend. I like this email. They send out an email sometimes kind of highlighting the projects that when you invest in Blend's P2P lending loans, they like to put a bit of a face and an actual house or a development picture so you can see really what it is that you're funding. I thought this was an interesting one that they sent out that I caught today. At Blend, we're proud to help investors access lending opportunities in property. Our investors are able to co-invest with family offices, institutions, and high net worth individuals. Again, this is the Blend network, which I personally don't invest through because they do have high minimums, which is a little too much for me financially. But if you're a high net worth investor, you can put in the minimum of £1,000 per loan. Blend has certainly got a good track record and worth a look. Goes on to say, our borrowers are very experienced property developers delivering great properties, great products, like this one we funded in Worcester recently. Ryan, the property developer behind the scheme, has spent close to 20 years in construction, or building as they say in the UK. Having completed numerous projects in and around Worcestershire, he came to us wanting to acquire a property in Worcestershire, refurbish it, and build a new house on the plot of land adjacent to it. Given his track record and experience, we were delighted to support him with the project. He certainly delivered on our expectations. Please see some of the images of the great job Ryan and his team have done. So this is the house after it was finished. Redevelopment. You can see that I thought there were more pictures. Maybe there's a couple more on Blend's website. There's actually some really nice pictures on the interior. The this guy's done a really nice job. Now, the reason why I like to highlight things like this is it kind of just really shows you the type of people that you're helping when you do peer-to-peer lending. Sometimes we can become a little bit wrapped up in the monetary part of it and maybe think, do we really care that much that we're actually helping small businesses or small building contractors to be able to do product refurbs like that? But it's really nice to put a face behind the actual borrower and to see what type of products they are completing. So let me see if I can pull up the other pictures here, because I think it's pretty cool. Let's see, can I zoom in? You might not be able to see this, a little bit small, but this is the original email. You can see they did a really nice job on the house, on the interior, new kitchen, really nice backyard area, and these doors, bathrooms. So it is cool to see the type of projects that your money actually goes to funding, rather than just thinking about purely interest rate returns, if you care about that kind of stuff, which I do. We had an investor update from Lendy, aka Saving Streams, also Lendy Limited, and it said, to all investors, the team are currently receiving considerable number of withdrawal requests. As previously advised, due to systems available, this is a manual task, and they have a skeleton staff, not many people on staff. Investors should anticipate an extended lead time for withdrawal requests to be processed and payments to be made. The current processing time is approximately 2 to 3 weeks. I got a couple of emails last week about people saying they had requested a withdrawal and they hadn't received their money. They were concerned about that, but when everything is being done manually and you've got thousands of investors putting in withdrawal requests, obviously they probably only have maybe one person dealing with that, and they have to manually do these withdrawals. It's going to take some time, so just be patient. Current processing time 2 to 3 weeks if you're a Lendy investor and there's money in your account that you requested withdrawal. It says, for example, a request made on the 16th of November may not be processed until the 7th of December. Please note, investors will be contacted directly by support team if there are any issues with the processing. Otherwise, we encourage you to wait for the 3-week period before contacting the team. To avoid additional delays and queries on payment processing, we request investors to thoroughly check their bank details before submitting their payment request. Yes, I've known of one person that actually didn't receive the money because their bank details were incorrect. They had old bank details in this, so that really delayed their withdrawal. So make sure, if you are an investor and you are withdrawing, make sure your details are correct. Kind of goes without saying, but some people do forget. Myself included, I logged in and saw that I had an old address on the account. Additionally, we ask that all investors make just one withdrawal request for the total amount of available funds to help speed up the process. If you're going in there and making a withdrawal for half your money and then a request for another half of your money a week later, it's obviously going to delay things. So good to see that they sent out information at least to let us know what is going on with that. So yeah, talking about peer-to-peer lending, investing, return-wise, on what has kind of been happening over the last 3 years. And going through the pandemic period, there was a lot of uncertainties about which of the companies were going to survive, how much were investors going to be expected to make. But I wanted to just go through, again, due to the email that I got from a gentleman who's in his mid-20s last week saying, I'm kind of new to investing. I don't really know where to put my money. I've watched some of the videos about peer-to-peer lending on Financial Thing and some other YouTube channels, but I also am interested in having some diversification because I don't feel comfortable necessarily putting my money all in one place. Which I replied back to him and said, that is a very, very wise thing to do. You never want to put all your eggs into one basket, or even two or three, because we've, as peer-to-peer lending investors, have gotten burned in the past by certain companies, and we got to make sure that we do diversify out. And it's no different to buying stocks. If you're somebody who likes to buy individual stocks and shares, you do need to make sure that you do diversify. You don't want to put all of your money into one individual stock. That's really highly risky. So of course we had some inflation numbers that came out on the 15th of November in the UK about CPI, Consumer Price Index, falling to 4.73%, which is very welcome. It's still high, of course, but it's fallen down from 6.3 down to 4.7%, which 4.7% increase from 12 months to October 2022 to 2023 is still high, but it is falling down. Now the problem is the interest rates are not coming down. Now they have leveled off, but right now we have an official Bank of England rate at 5.25%. You can see just how low these rates were back in 2020. Absolute rock bottom, 0.1% for April of 2020 to December of 2021, and that's when we started to see this inflation issue, and those rates really start to bump up. Boy, did we have it good for doing things like mortgages back then during this low time. So compared to now, a lot of people are struggling. I read a report about mortgage interest. A lot of buy-to-let people are struggling with these repayments because their variable interest rates have gone up so much. So bearing in mind these numbers of inflation and interest rates, we again start to look at how can we beat that inflation rate, most importantly with the investments that we make. And we have a few different options, right? We have stocks and shares, index trackers, private lending, property investing. Sure, you could do things like insurance, annuities, and things like that, which personally I'm not a huge fan of. Peer-to-peer lending, you got cryptocurrency, so you can create sort of a nice basket of different things depending on what you're into and what you're not into. But one thing I wanted to look at is, based over the last 3 years, would I have been better taking the money that I invested in peer-to-peer lending in certain companies and putting it into trackers, or putting it into other places? So I wanted to kind of take a historical look back. And right now, too, by the way, if you are just looking at pure savings rates, you're able to get about 5% now, which is still tracking underneath the Bank of England base rate. Through Skipped and Paragon's got 5%. It's pretty good for double access. Means you can only access it twice a year. They're always, banks, these big banks are always placing rules, aren't they, on you? They can't just give you the interest. They've got to have all these rules about how many times you can access your money, which, to be honest, doesn't make any scrap of difference to them. It's just a reason for them, to make you keep your money in place so they can lend it out to other people for much more than what they're paying you in interest. But that's a discussion for another time. So yeah, you can get even Marcus right here, just no notice period, 4.75%. Forward money's paying, I think, about 4.6. So, with that inflation rate about 4.7, you're getting closer to that parity where you can try to match inflation with your savings rate. But of course, here we try to eke out extra returns, right? Our goal is not just to match this inflation rate with savings, because that's not going to be good over the time. Your money is going to get eroded, especially when inflation is higher. So what I did is, probably the four companies that I speak about most is LoanPad, right now offering 6.5% in the premium account, but if we look back to 2020, those rates were about 3% less. Then Cufflink, which they say you can get up to 9.83%. That's with the automatic lending system that they have going on there. And then crowd property, who some people have been able to get around 9 to 10%. I was not so lucky with that. And unbolted. And then also on the tracker side, we got the US equity tracker, which has been doing really well recently. And the Fidelity Global Tracker, these are the trackers I use myself. And then our Trading 212 portfolio. So here's the graph that I plotted for. This was really, I entitled it peer-to-peer lending versus equities, because equities I really consider index trackers. And this is the graph of the returns. Now this is every year, so a percent annual return. I plotted it from November 2020 until November 2023. So the end of month November to end of month November 2023. So a period of 3 years. So as kind of expected, LoanPad was the lowest, but also I felt offered the lowest risk. And I'll talk about risk, because risk does come into this. And obviously we had this crazy result at the end, but I'll show that to you. So LoanPad 4.33% annually per year for 3 years. Cufflink 6.47%. Now the thing about Cufflink, some of those returns were a bit lower for me because I got a bit lazy with my manual investing account. There'd be times where I wouldn't log in for a week or two and have money sitting there, and so I experienced some cash drag in Cufflink. Also the same with crowd property. I managed to score about 7.93%, but I also noticed one day, I hadn't logged in for a while, and I noticed that my settings on the auto invest were not set correctly, so I had some cash drag that happened there for crowd property, but still not a bad result. Unbolted is a little bit less, 7.65%, and that was because of the auto lend settings that I had in Unbolted. Mine was set very conservatively, and you could get definitely more aggressive with your settings and get a higher rate, but I had excluded some of the higher paying loans, just the business loans and things like that. At the time, I just wanted to do the gold and the PAWN type loans. And then if we look here at the Vanguard US equity, we managed to achieve 9.26% annually over the 3 years. And the Fidelity World Tracker, 8.96% over the 3 years. So not much of a difference there, around 0.3%. Actually, if you backtrack the Fidelity World versus the US tracker another year past that, those results become a lot more skewed. I think I tracked it either 4 or 5 years back, and it was about 14% difference. So the World Tracker did catch up, but for a time it was really, really underperforming. And then here, the anomaly, which was the Trading 212 portfolio that returned, it was close to 72% per year. And a lot of that was due to the Trading 2 portfolio just happened to hit at the right time, right before that big jump in equities. Fooling around with trading individual stocks. I would say a lot more of it was down to just dumb luck than technical expertise when it came to that. So this is not really a good example, but I wanted to show it in there. I think it could have quite easily gone the other way if I'd have invested, say, 3 years down the road and had put the same amount of money, and I might certainly be at a negative on this portfolio, but just happened to get very lucky with that. Now the thing about this graph chart is we do have to look at risk versus the reward. It's hard to quantify risk in some of these peer-to-peer companies versus, say, the Vanguard equity tracker. Now if you look on Vanguard's website, they're going to show you a risk factor of 6 out of 7, which is almost the riskiest product that you could invest in through Vanguard. Is it really that risky? I would challenge that and say maybe not, because you do have a massive amount of stocks in the portfolio of the US equity tracker. The problem is a lot of those stocks are made up of the huge jumbo ones at the top. So you can see right now Microsoft is making up 6%, as is Apple. Look at that, almost exactly the same. It's 6.13%. So you got 12.26% of the entire index now is made up of these two giant companies, Apple and Microsoft, and then 3% Amazon. So if one of these stocks has a bad day, or a really bad day, then that really hurts the indexes. So that's probably why they are putting the risk at such a high level. I personally don't really see it as a 6. I'd probably say it's more like a 5. But if you look at also the Fidelity World Tracker, which I consider a little bit less risky, that is also marked at a 5 out of 7. So again, you do have to kind of put those risks into your assessment. There are some people that would say some of the peer-to-peer lending companies are less risky than these trackers because it's risky in a different way, because when you put money into a peer-to-peer lending company, you can kind of hope that your capital balance will remain constant. So if you put £1,000 into LoanPad, the hope would be that in a year's time, let's say you were withdrawing all of your interest and just leaving your capital balance, you would hope it would remain at £1,000. When you invest into a US tracker or a stock, even if it's something that you think is low risk, you have an opportunity that stock can actually decrease in value and could lose 30, 40, 50% if there was a real stock market crash. So there are some people that would argue that some of these peer-to-peer lending companies are not as risky actually as doing these tracker funds, or certainly this trading 212 portfolio. So LoanPad I would definitely put at the lowest risk in the peer-to-peer lending category. If I were betting it against, say, the US tracker, I would actually, in my opinion, think that based on just investment risk alone, it is much, in my opinion, again, not financial advice, it is much of a lower risk product than this equity tracker. The problem with peer-to-peer that you have is the risk of company failure. As we've seen, several times in the past, we have 3 different types of risk really in peer-to-peer lending. We have interest rate risk, the fact that we're not getting it, close to or much higher than inflation. So some of the lower risk peer-to-peer companies are providing us with interest rate risk. The other thing we have to deal with is obviously company failure risk. We've seen before with collateral fraud, Lendy, some people could say fraud, and then some companies that just failed and couldn't continue, wrote bad loans. So we have company failure risk and then loan risk. Loan risk, I think, is what probably in most cases with peer-to-peer lending companies brings down the company. So if they write bad loans, then the company becomes at risk. So that happened obviously with Lendy, funding secure, money thing in some ways. And then you just have straight up company risk with companies like Collateral that just defrauded us, defrauded everybody. So you have 3 layers of risk. So it becomes quite difficult to quantify actually what the different risk levels are. But these results are obviously going to be skewed by the raises in interest rates, because back in 2020, interest rates were much lower. So we were seeing numbers in LoanPad at like 3.5%, 3% interest, and also lower with all of these companies, which have now raised their rates. So if we were to look forward, say 2023 to 2026, I could think you're going to see much more attractive, obviously, results as long as the loans don't fail. Now, with this trading 212 portfolio, we had the biggest return, but we also had the massive amounts of risk. I mean, off the charts risk in some ways. Portfolio that maybe held 6 different shares at some point. Lack of trading knowledge on my part, but took a swing for the fences and happened to get lucky. Now, if you think about the trading 212 portfolio, and I'll show it to you. Let me log in real quick. I'll show you what's going on with it. But there has been some definite drawdowns in that portfolio to where the balance of it was much higher than it is today. So you are actually seeing a much bigger level of risk in this portfolio than you would say with the US equity tracker. I'll show you this right now. We're sitting at 17,354 pounds on that, which at one level, one point in time, this was close to 20,000. So that's been about a 1,300-pound drawback, which is about 8%. And at one point, it was much lower than that. I think it was about 12% that it had fallen back, which I think is lucky. I think it could have been a lot worse. I mean, if you look at some of these shares that were bought, I mean, we're in the negative 34% here. Green Power, negative 36% Vermilion, negative 33% Creative Reality. So obviously the risk level on this is just much, much, much higher than even, I would say, all of these peer-to-peer lending companies. I think that the Trading 212 portfolio just massively overshadows risk-wise any of these investments. So obviously when you have low risk, you're going to make less money in theory. That's the way it should be. So I would have been quite happy, I think, just probably putting most of my investment money, if I was investing in equities, into these trackers here. Preference for me has always been the US tracker. I just think it's done better. Well, it has. It's not a thought. It's just outperformed the global. But obviously you have risk there too. If you're investing purely in US companies, you got geographical risk, even though those companies do sell products overseas. You have risk of country risk. I mean, look what's happening right now. Some of the conflicts in the world, Russia, got the Middle East. All it takes is one, problem within a country to bring down its financial system. Probably unlikely that it would happen in a place like the USA, but it could. I mean, you always have to think about the possibility. So results, pretty decent. If I probably back tested this to when I started investing in peer-to-peer about 8 years ago, these results should be higher. But then if I were to add in the losses or potential losses from some of the companies that failed, these results as a whole, not through the companies individually, but as a whole, the peer-to-peer lending portfolio would probably be much worse than these trackers, and certainly the Trading 212 portfolio. So if you are thinking obviously about risk and reward, you do have to take these things into consideration. I do think now with these numbers that companies like LoanPad are offering now, it's 5.5% and 6.5%, and certainly Cufflink with its increased interest rates, Crowd Property, Unbolted have all increased their interest, which makes it a lot more attractive when you consider the inflation rate is dropping and hopefully will continue to drop. What I wouldn't bet on is these interest rates dropping to where you think they may go to. I've heard people tell me, I think the interest rate is going to go back down to 2-3%. I don't see it. I think you start to reduce these interest rates back down, you're going to cause these inflation rates to go back up again. We do love to spend money. That's one of our biggest downfalls, I think, in the Western countries like the UK and the USA. We love to spend money. We love to charge things on credit cards, and just can't seem to help ourselves. I think those interest rates start to come down too much, that inflation rate starts to go up. If the interest rates do start to fall back too, the big question is, do these peer-to-peer lending companies start to reduce their rates to remain competitive? And I think the answer to that would obviously be yes. But at these rates now, they're pretty attractive. I'm happy to continue reinvesting interest into these types of rates through through LoanPad. Cufflink has become a bit of a challenge personally. I mean, full transparency, £500 a loan. Now, you really need $5,000 to remain diversified. You don't want to be just buying one or two loans, because I think in my portfolio right now I do have one default, and if I only had a couple of loans and had a default, that could be an issue. That could really tank your returns. So, if you are somebody that has more money, you're a higher net worth investor, and you can put in the diversification amount. I think having at least 10 loans in any company is about what you need to be well diversified if you don't want to do the research that it takes to manually look through all of the loans and check out the borrowers and do your due diligence, and you're just somebody that wants to go the easy path. You do need to have about 10 loans to be really well diversified. But at the rates they're offering now, I think they are attractive enough to really beat what you're going to get in savings accounts for the risk that I think you're taking through these peer-to-peer lending companies. The tracker's done pretty good over the last, price and performance. Let's have a look here. Show me the chart. Yeah, it's lost 10 pounds. Let's see where we are for 3 months. Yeah, so when we were down here in October, 744, we did clip about 800 pounds with the tracker, so it's done okay. We've had a pretty volatile stock market year. Seeing these ups and downs. We've had a bit of an increase from a year ago at 752, so it's not been too bad. So I don't really think there's anything much to do with these trackers. You got a 52 week of 689 and a 52 week of 804 pounds. They're just so easy, and it's nice just to have your money put into one fund, even though it is weighted by those two major stocks of Microsoft. And what was the other one? I forgot. Microsoft and Apple. Yeah, Microsoft and Apple 12%. But it's an easy way. And if you don't like that, just go for the global side of things. You can invest, just in the countries, through the stocks in the countries. You'll get U.S. exposure too. There are people that say the global market will do better than the U.S. market. Projected earning growth 10%. We'll see. We'll see what happens. The thing about this tracker too, you see you have a bit less of a dilution. A bit more of a dilution with Apple being weighted at 4.85, Microsoft at 4.32, but you can still see a lot of U.S. stocks in the top 10 holdings. So you're going to get exposure. So it's not a bad thing. So I thought it was interesting to look at those results, and I think I've taken definitely more risks than I should with certain investments. Even within peer-to-peer lending, it'd be nice if you could look back and go, wow, if we'd have known what we know now back 4 or 5 years ago, we would have just picked the solid companies and kind of went with them and not diversified out too far into, at one point I think I had like 15, 16 different peer-to-peer lending companies, and part of it was because of the website. I wanted to kind of showcase what was going on with the with the entire sector as a whole and show you what the results were like. Unfortunately, when you do things like that, one of the companies, two of the companies, 3 or 4 or 5 of them go bad, your portfolio really takes a hit, and you take, it just sucks, right? But I would imagine as most investors out there watching this, you're not going to be doing things like that, especially if you're starting now today. I think there's companies out there that have really good track records, like the ones we tend to focus on here, who will give you solid, stable returns over the next 3 to 5 years and hopefully onto the future, where you're not taking too much risk on to get that better than savings rates. And I think these bank saving rates too will start to fall too. 5% is pretty good, right? I'm not going to lie. I would not even look at these fixed rates of 5.6, 5.5. Just no point in that when you can get 5% on instant access. But you do have to look at ways to increase. looking at the trading 212 portfolio, you can see I have added here to the Coinbase position. Today was a bit of a down day. It was actually down, you can see here, all the way down to 119. So it was 128 yesterday. It took a pretty decent hit and then powered back. So I did add to the portfolio. Let me see what I did. I can't remember. I put in a buy order at, let's see what we paid, 124.01. So I set a limit order. I usually just buy market, but I don't know. I felt like the stocks had such a good run up over the last couple of days. I thought maybe it was an opportunity just to add to position at a better price. So I did that. And so now we've got about 1,458 pounds worth. Probably add to that too again if it pulls back. We're up a little bit, 3.27%. And then Rivian, you can see here I've got a couple of limit orders in at 16.50 and 16.15. Whether those get filled, I would imagine they will eventually because it's a pretty volatile stock. But we're up a couple of percent on that. And also I would reduce the Deutsche Bank position. Had about 2,500 pounds in that. And I sold some of that off. It's kind of been a little bit of a rise up. I thought it might be a decent time to reduce the position a little bit and to put into these other two stocks I think are going to do better than what I think Deutsche Bank is going to do, but we still got some exposure to Deutsche Bank. This created realities. There's just trading 212 really did me a favor when they put a limit of, I think it was 350 pounds of maximum purchase that you could do for creative realities. I don't know why it was like that, but I actually tried to go heavier into it and that would have been a mistake. So they saved me. Thank you, Creative Realities. Alibaba still seems to be on this decline. But yeah, their revenue is like super high, so I'm not really sure why the stock price continues to suffer. So I'll probably hang in there with that. Yeah, so plan is to probably just continue adding to Coinbase and Rivian. If we look at the Bitcoin price, as I said last week, I think Coinbase for me is going to be a strong position in the future. Bitcoin keeps wanting to pop over this 38,000 US dollar line. If it can hold that 38,000 amount and these ETFs get approved, I think you start to see the price take off, and also Coinbase, this stock will also start to take off too. This is a pretty interesting graph that I found, some data on blockchain.net. Whether you're interested in crypto or not, I think this is really interesting. Dollar cost averaging or pound cost averaging, as we say in the UK, is where you just basically take a fixed amount of money and invest, whether it's monthly or weekly. Instead of trying to put in a lump sum all in one go, you invest it over a period of time. So you could take £1,000, put in £100 a month for 10 months. This is a really interesting graph. Just shows what would have happened to you if you'd invested $10 a day back in 2016 into Bitcoin. You'd be up 1,267%. And then the graph shows you as you go on, if you just have done it in 2023, 2022, 2021, pretty nice numbers, even considering you had this big crypto crash. From just a purely investment side, if you'd put in $10 a day, just kept going with it, you'd still have been doing pretty nicely. And even its worst time in 2021, when Bitcoin took a massive poo, you'd still be up 24.4%. Obviously, I don't really mess with too many of these other coins anymore. I think those are very, very high risk. Probably not good in the long run, but we'll see. Just Ethereum, again, if you'd have done the same thing 2016, just put in $10 a day, you'd be up 5,000%. So, of course, everybody would love to have seen those types of returns. Another interesting point about Bitcoin is we're going to see a halving coming up in 2024. So every 4 years, Bitcoin halves its supply as it tries to get to, was that 21 million coin supply. And this is really cool little visualization showing where the Bitcoin supply is. So we have 2,077,000 on exchanges. So that's places like Coinbase and Binance. We have 1.75 million zombie coins. So what a zombie coin is basically a coin that has not moved since 2010. So they're just sitting in wallets. People who are either holding on to them or either lost them or forgotten that they own them. We have 1.125 million owned by Bitcoin's creator, Satoshi Nakamoto. Most of these have not moved. 625,000 in the Grayscale Bitcoin Trust, which will be turned into an ETF, a spot ETF. Once that is approved, they are one of the applicants. 328,500 mined per year. We've got Bitcoins that have been seized from scams, blah, blah, blah. And then it goes down. You can see Tesla down here, 9,700 owned. And here is the rest of the supply in circulation. So that's quite a lot. And then this is what's left to be mined, 1.4 million. So really not much left in the supply of Bitcoin as a whole. It's pretty crazy. Cool. Yeah, if you like to look at data and visualizations and interesting things, they have the rainbow chart, which I think is super fascinating. It shows you historically, based on price, would this be considered a technical buy or sell time? You can see the red is a sell, get the hell out, and the blue is accumulate, or where it's still considered cheap. So yeah, shout out to blockchaincenter.net for some really interesting graphs. Anyway, that's pretty much all I've got for you. Again, I'll be letting you know when Narinder from Cufflink will be coming on the stream live to answer all those questions, and we can ask him about why the hell they decided to reduce their minimum loan amount. But please hit thumbs up if you've enjoyed the stream, and I'll have a look and see if you have any interesting comments before we head out for the weekend. I hope you're planning on having a good weekend. You stay warm. Alan Stratford says, I'm in 8 loans of brick owner. All of them are very late and many will be losses. I was lucky to escape without an overall loss. Yeah, that's too bad. Got a couple of loans on Blend. Cash drag is a pain, not enough new deals. Yeah, they're always balancing, right? New deals with cash drag. They don't want to just put deals up just to have them up there. They want to make sure they're picking quality loans. That's why you're going to see that. Hello, Annabelle. Hola. Done a few loans with Propland. Yeah, I think Propland's a good, solid solution. There are other good, we've had I think the people we've had on the stream, I would generally say, are running really good operations. Hope they don't let me down, but Capital Stackers is another one. Yeah, comment about Cufflink. Cufflink has been rated pretty high by myself and also Fourth Way. So we'll see what happens in the future. You never know. There's never a guarantee. Even one of the CEOs of a peer-to-peer lending company told me, one that I trust very much, that any one of them could fail. I mean, it's like with the company, right? You have enough problems stacked up, things can happen and they could fail. Likely now, I would say not so much, but you always have that risk. So just make sure you understand the risk. Anyway, that's all I got for you today. I'll be back next Thursday. Hopefully with Narinder, if not next Thursday, following Thursday. Just keep an eye on the channel, join the Facebook group. I always post in there about the streams and sign up for the Financial Thing email list. If you haven't, it's on financialthing.com. I send out an email every week saying when the stream is going to be, what time it is, and who's going to be on. Most of the time, just me, but when we do have guests, I'll post it in there. Have a great weekend. That is all I got for you. Thanks for being here. Love each and every one of you, of course, and I'll see you next Thursday. Take care. Bye.